The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, and welcome back to the Option Block, your bi-weekly source for options, wit, wisdom, and hilarity. My name is Mark Longo from the OptionsInsider.com, as well as the Old Options Insider Radio Network, and I am joined on this lovely, lovely Monday afternoon here in sunny Chicago by the usual suspects for the old all-star panel, starting off with the man from OX by way of the Eiffel Tower, one Tim Navabi from Options Express. Mr. Tinav, welcome back to the show, sir.
Hi, Mark. How are you?
I am doing excellent, sir. Thank you.
Good. You know, you mentioned sunny but not cold. We've got a sunny but cold day here in Chicago.
Yeah, we're not exactly reaching the highs that we hit the last few weeks with the 60s and 70s and pushing into the 80s a few times there. It's in the 50s, but hey, it's Chicago. That's still unseasonably warm for this time of year for us, so we've been spoiled by recent events. Speaking of spoiled by quality weather, we also are joined by one Andrew Giovinazzi of lobster competitive eating fame, also from OptionPit.com. Andrew, welcome to the program, sir.
Thank you. I'm not moving, so my sound is good.
How many lobster rolls can you do at one sitting, sir? What is your record?
Well, if I go to Red's, really only one because it's a full lobster. But when my wife makes them, like maybe two or three.
They put a full lobster in one roll?
Yes. It is a monumental roll. And then people line up blocking traffic in the town of Wiscasset. You can't go anywhere.
That almost
it takes an hour to get through town.
That almost defeats the concept of the roll. You might as well shove a lobster in front of you and just go to town on it.
You giggle and you laugh and you mock and you scoff. But when you sit down and have that tasty roll with all that butter, you will think differently.
You know, that is what we do on this show. We giggle and laugh and scoff. I don't, not so much on the giggling with me, but that's more of a Sebastian thing. But laughing and mocking.
You chuckle and scoff.
Yes, I do chuckle and scoff quite a bit.
Like they're doing with Netflix right now.
Yes, in a deep, deep manly fashion do I chuckle and scoff. All right. And we will be joined, hopefully a little later, by good old Federal Holiday Mike, a.k.a. Mike Cavanaugh from Know Your Options Inc. He had to declare a last-minute federal holiday today, but he's hoping to join us as the show is underway. And speaking of getting underway, it is time to roll right into the trading block.
The trading block.
All right, and that trading cacophony means it's time once again for the old trading block, the portion of the show where we break down what was moving the markets, what was lighting up the old tape today, and it was a sea of red for the most part across most of the major indices. Today we saw the S&P down about 0.8%, or 12 handles roughly, to 1367, and the Dow down a similar percentage, down about 0.8%, or about 100 handles, to 12,927. The good old Apple Plus, aka Nasdaq, down a whopping 1%, or 30 handles, to 2970, as Apple dragged the rest of the Nasdaq with it today. It actually closed a little bit off its lows of the day, so it's not exactly the worst we've seen from Apple of the day. Apple was trending much lower earlier in the session, and then of course we have the VIX Cash trending to the upside, up nearly 9%, or 1.5 points on the day today to 18.95. I do believe, correct me if I'm wrong, Andrew, that it did cross the 20 mark at one point during the day today, correct?
Mr. VIX?
Mr. VIX, yes.
Oh, yeah, Mr. VIX definitely crossed. And actually, it was up around 12% on the day when we only had around like a 1.2% drop in the the broader market. So it was definitely a little overcooked, and it quickly sold off from that level. I guess is the easiest way to say it.
You had a much more elaborate do stuff analogy in mind, and you just went the simpler route instead.
There wasn't much to do. It's just it's one of those things where I was looking at buying the XIV, and then I got sidetracked, and blah 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 blah, and then the VIX was down about one whole handle. The thing though, VXX wise, and like the futures, was weird. On Friday, future cash spread was around $3 or more, and today it crushed down around 1. So most of so if you were long the futures, you were very unhappy today because they basically compressed huge, and you didn't get the bang out of the buck that you wanted. So that was a little bit of you got to move, but you didn't get the big kajing that you wanted. So, and I guess there was some premium in going into this French election, and they sapped it right out today. And of course the VIX going down. So you did not take your chance this morning. You would not be able to afford any tasty beverages in the afternoon after work.
Yeah, that old term structure in VIX just comes back to bite you again and again these days. That really is definitely becoming a very nuanced product where if you want to trade it actively, you could easily get bitten on simple things like the term structure coming back to bite you on a day like today when you think you would have been doing fairly well given the fact that you were long some of those near-term futures. But the term structure rears its ugly head and lays you low yet again. Speaking of
yet again, it's so true. I think I'm counting like 3 or 4 layers of insurance inside the VIX. I think I'm at least up to 3 now. You got the term structure premium. You got the volatility of the VIX. You've got the skew in the SPX. I mean, there's so many little built-in squishy factors in those things. Lots of levels to compress. So when you're buying it for protection, you got to be real careful on what you're looking for and really try to wait till those things get relatively cheap. So it ain't easy. That's all I'll say. Ain't easy.
And of course, speaking of extreme movements, we also saw, and also things coming back to bite you, we see the widowmaker rearing its ugly head yet again today. Netflix is announcing here, just announced after the bell, as we're recording, stock closed down about 4% to nearly 102, 101.84 today. And in the after hours, it's trading down about 14 handles to 87 already. So not exactly a rosy picture for good old Netflix. We're already pushing the level here of the front month straddle. The weeklies went out at about, looks like 17 points, 16, 17 points for that front month APE 100 straddle. So we're testing the limits of that. Of course, if you're a degenerate premium seller these days in Netflix and you haven't at least hedged your wings or done something else to hedge your fully naked exposure, and maybe perhaps and you haven't instead rolled from perhaps naked downside puts to an iron condor or something like that, then I'm not sure what it takes to teach you the basics of risk management. But this name definitely has exhibited some nasty behavior in the past, and looks like it's probably going to do something similar again today. The traders in Netflix right now are, if you're a size primo seller, then you might not be too happy. What was the consensus going into the earnings tonight? I know Netflix was kind of the belle of the ball over at OX, leading into the late summer, early fall apocalypse that happened, that kind of cut it down by 2/3. And I know Netflix kind of fell off the radar for a lot of OX customers after that because a lot of them got shaken out. What has it risen back to prominence again? Tim, did you get a lot of Netflix calls today?
Today on Netflix, no. Not as much as Apple. If I look at some of the OX most actives here, let me take a look. Where was it on? That's down towards the bottom of the list. As far as most actives at OX, we had Apple, the SPY, the Qs, Bank of America, SPX, RUT, IWM. There's Netflix right there, Priceline, and then Google. So just not as high on the list, but still on that list.
That's surprising. Even going into earnings, it can't outpace good old Apple. I mean, I just assume Apple's number one or number two any given day. Tuesday morning, right. A random Wednesday morning at like 9 o'clock in the morning, Apple's number one. Apple's end of the day, number one. It doesn't matter. I mean, Apple seems to be just the belle of the ball, regardless of the day or the market activity. But I thought Netflix may have started creeping its way back up there again. It is obviously relatively popular again, but nowhere, apparently well off the highs when everyone and their mother was writing downside puts in Netflix as fast as they possibly could.
Yeah, I mean, it kind of, goes to what you were saying, that, it hurts, from the last time, when people were doing that and not necessarily monitoring the risk, then, it's tough to come back. I guess what I'm trying to say here. Really stings.
That one going from 300 to 100, that'll leave a mark on most premium sellers, regardless of how much risk management you employ.
That will be a skid mark on everybody's brain after that.
So yes, we will keep an eye here on the widowmaker for you throughout the show and see if we see any developments, but as of right now, things are not looking too rosy out there in Netflix land. And speaking of the beast, the belle of the ball, the NASDAQ minus, perhaps, because it's just Apple. What were the folks piling into in Apple today, Tim? Were they positioning for some short downside premium ahead of earnings? What was the, if there is a consensus given such a highly liquid name like that, if there was a consensus that you saw, what was it?
Yeah, it's a good question. I mean, they were doing everything, anything they can afford, really. I didn't see too many vertical spreads put on, but a lot of people buying some calls, some short term, some long term. And we'll talk about those later. But buying calls, buying puts, it's pretty much what they were doing.
And Tim, speaking of Apple and what you can afford, you didn't have a chance to weigh in last week when we had an interesting question from a listener asking about what account size he thought you needed to really trade Apple options effectively. And Andrew and I had a chance to weigh in on that, and John did. But I'd be curious to hear what you think is a suitable account size for Apple to go maybe a little bit beyond just slinging the occasional one lot, but do some actual size, maybe a 10 lot here or there.
It's a good question. It also, I think, it depends on how active. I mean, I would say, somewhere in the neighborhood of $10,000 to $15,000, and that would be a very conservative amount. Doing very conservative trades. That would not be very, very active at all. I think, if you want to have activity, I think, somewhere in the neighborhood of 50,000, something like that.
Yeah, Andrew and I both came down on the 6 figures plus side of the equation, just because, if 15,000, you probably do a handful of one lots. That of course also is assuming that you want to maybe have some capital left over in your account for other trades aside from Apple. So, yeah. If you want to do that.
You would need portfolio margining for that. You would need 100,000 plus. That's the only way I see that really works. Unless you're kind of being a butterfly guy all the time, which actually Apple has suited that position enormously well over the last month or so, at least 2 months, since it's become this kind of hyperactive trading name.
Right. Yeah. I remember maybe it was last earnings or just before last earnings that you had mentioned some butterflies on Apple. And that amount of 15,000, I mean, that's a very small, I mean, those are small types of, I mean, if you just want to get your toe in the water, doing small things, that's what I would say. But, I'd spoken to someone maybe 6 weeks ago, maybe 4 to 6 weeks, and, he wanted to buy as much Apple as he can and sell calls on them. And, he said I should be okay with about a $200,000 account. And I said, well, I mean, do you know where your risk is? And he said, well, the risk is, to the downside. I said, yeah. I said, so, are you okay with that? I mean, are you okay with the 200,000 at risk and, maybe losing 50,000, 75,000 if just, something goes wrong? And he said, yes. I spoke to him today. He didn't remember me, but I remembered him, and he was sweating a little bit. He was not in a very comfortable position, and he definitely had taken it on the chin a little bit, and he was trying to do some repairs. So, I mean, big account sizes, 200,000, you'll get scared even. I guess is what I'm trying to say.
Even on an account size like that, you're right. I mean, obviously he was looking to do mostly Apples. He wasn't concerned about diversification and things like that. But it's still interesting to see just how much of even in a sizable account like that, Apple can eat up very quickly, just doing some very, very small trades. And you're right.
Don't forget, Lehman went through billions. Effortlessly.
Yeah, that's
right.
true.
It's all risk relative to account size.
Yes.
The old saw on Wall Street. How do you make a small fortune on Wall Street? Start with a large one. So people have to understand how to manage risk, and that's one of the things at Option Pit we work on the most with guys, especially that are professionals. We're like, okay, let's just get down to one Greek risk. You've got like all of them on. Why don't we just get down to one? Let's see how that works for a while for you. And start to learn how to moderate, well, it's because the reality is a lot of people do well selling premium. You could catch a great string for a good period of time. And there isn't an option that you see that you don't want to sell. The problem is we all know that can go horribly bad. So we'd like to get people to just be a little more controlled in how they sell. And Apple, that's why there are lots of plays, because we have all this intraday volatility in Apple that makes it a very interesting daily trade. So if you have an account minimum, it definitely it's worthwhile to trade this stuff essentially.
Yeah, and again, when I was speaking to him the first time, I said, I mean, I always call it the sleep at night factor. I mean, if you lose half your account, can you sleep at night? And he was saying, oh, this is, this 200,000 is here. This is nothing. This is just pennies. I mean, I've got a lot of money. This is risk. I can lose it all. Well, it didn't sound like that today. I'm sure he does, probably have many more assets, but, just the fact that you are watching the account, it's, I mean, it was your trade. It was your idea, and all of a sudden it's cut in half. You're not comfortable. I don't care how much money you have.
Yeah, that is a perfect way to truly gauge your risk tolerance, is when it actually happens to you. How do you feel then? You can talk all day about how you can shed many hundreds of thousands of dollars without blinking an eye, and yet when a push comes to shove, when you're short tons of premium coming into expiration or those sorts of fun days like that, that's when you see exactly what everyone's true risk tolerance is. And it's easy to determine usually by the people who are just popping the tums, or they're the ones who are crying on the phone to Mr. T-Nov saying, get me out, get me out. I literally cannot sleep at night anymore. And one thing I will dispute about what you said, Tim, is I don't believe anyone could forget you on the phone. An impossible thing to do, sir.
It's not always in a good way.
All right, thank you for that, Mr. T-Nov, and for sharing that interesting story with us. And that's going to put a lid on the old trading block for today, and now we're going to dive right into the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the odd block.
All right, and welcome to the Odd Block, and I do so love that Odd Block theme. It just puts me right in the perfect mood to do some odd blocking, and we're going to kick off the old Odd Block today with Aastrom Biosciences, Inc., ticker symbol ASTM. This is a name that usually, well, first off, today they closed at $2.64. So this is the name that's lighting up the tape anyway. And on a given day, from an options perspective, they do about 200 contracts a day. Today they did a whopping 10,000, almost 10,500, and it was on about a 47-to-1 call to put ratio. So as you can imagine, a lot of activity in the old calls in ASTM, and what we saw really was a pretty sizable May-Aug 2.5 call spread going up about 5,000 times. The paper was buying August and selling May, and they netted it out. I don't have the prices here, but probably looks like it was around somewhere in the 30 to 40 cent range. And it looks like if once you start peeling back the onion of the open interest here, there was nearly 9,000 open on these May 2.5, so it appears that this person is looking to extend his bullish bet on the old ASTM for another few months, and rolling it into August. So size upside bet here in ASTM being extended past its sell-by date out to August. And then next up on the old Odd Block, we have yet another little name. This is IAC Interactive Corp, ticker symbol IACI. This is another one that lit up our hot options volume scanners this morning. Usually does about 500 ADV, did over 11,000 today. And this is the name that usually closed today at about $46.11, down about 3% on the day. And what we saw today was essentially one sizable trade here in IACI. We saw 10,000 of the May 45 puts going up. The bulk of them, it looks like an opening purchase for the most part. There's only 100 or so contracts open on this strike, and we saw the bulk of these puts going up in the $1.25 range, including a massive block of 9,200 for $1.27. And this looks like an opening purchase given everything we've seen here. So it looks like someone's coming in to defend an underlying position, perhaps ahead of earnings. Earnings are on the second. Could be an outright spec as well, but it looks like someone's got some size IACI in their portfolio and is looking to hedge that going into earnings. Again, earnings are on the second before the bell here in IACI. So we'll have to keep an eye on this one and see how it plays out. And then last up in our little name odd block for today, we have Old Fields Ltd, ticker symbol GFI. And Tim, I know you're active in the commodities a lot. I know Tusaw's in here. He'd be the perfect one to ask. But have you ever traded this one or heard of GFI?
Oh, yeah, I have. It is popular at Options Express. I can't think of anything specific or when the last time I took the order, but yeah, Old Fields Ltd is definitely familiar.
All right, so we saw some very interesting activity going up in GFI today. It looked at first glance like a size vertical call spread where paper was coming in and selling 8,000 of the July 15-18 call spreads. And if you look at the open interest out there, there's about 17,000 open on that July 18 strike. So obviously this customer was trying to roll down a bit. And that initially made a lot of sense because this name has been on essentially a downward spiral ever since earnings back in February. The stock was trading about 16 then, is trading about $12.30 today. So this guy is chasing his short calls positions. Either he's closing out some naked shorts or he's rolling down his covered calls against his underlying, whatever the case may be. It looks like he's rolling that down. But then if you roll that out a little farther, we also saw 8,000 of the IAC 16 calls going up today, and those were sold for 13 cents as well. So it looks like he rolled down from the 18s to the 15s, and then he also sold the IAC 16s as something of a time stupid, I suppose you could call it. What would you call this, Andrew?
Yes, I think a time stupid is about as accurate as a description is. I do find for a stock that has not done very much lately, I find these upside call skew kind of a little interesting. I mean, I know it's a gold stock. It just must be this customer that was long all these out of the money calls, driving up some of the volatility in here a little bit. That's what I was just trying to garner and glean from some of what I've been looking at in this bad boy. So very interesting. Very interesting. I mean, this is, this is options that really should be not worth a whole lot. And yet they are worth something. So this is I think it's a customer that is kind of beating people around with his volume on this particular stock that he seems to love, that is not doing very much. That's how I read that today.
Actually, now I'm looking at this, this tape is so messed up here on this 8,000. There's like 3 massive canceled orders on this July 18 strike. They had him printing for a penny. They canceled that 8,000 times, and they had him printing for 6,000 times at 3 cents. Is what we saw when we wrote this up earlier this afternoon. That was still a valid trade. Now that's canceled, and now they have him up as essentially, it looks like a sell of nearly 6,000 at 3 cents. So in which case, this guy not rolling. He's flipping. He was long these calls. And then it looks like he's dumping them now, at least 6,000 of them. So that's a different story. So listeners, there's yet another wrinkle in this tail of this tape here, and this is why it's always so fun to parse some of these trades, because since we wrote this up earlier this afternoon, the earlier trades we listed with the buys of 6,000 calls at 3 cents have been canceled, and an 8,000 lot that went up in the morning on the Philex for a penny was also canceled, and what we have left is actually a sale of about 6,000 of these calls at 3 cents. So it looks like these could have been closing sales, in which case this guy is closing out a long position he had on the upside, which would explain some of the skew, because you're right, the skew was a little wacky out there, and I was trying to reconcile why that would be the case with all these shorts across the board. But if he had long on that July 18 strike, so instead, apparently he's changed his worldview now, because he's rolled down to the 15s, sold those after he was long the 18s. I guess you love it the 18. You gotta really hate it at 15, right? And then he's also selling the AUC 16s.
And he rolled into the time spread, I think. So he ends up with, okay, I'm not getting anything done at the 18 handle. I'm going to blow those out. I'm going to sell my Julys because it ain't happening this month. And I'm going to roll out to the 16s in October, and I will wait and wait and wait. I think that's what he did. So it's still a long spread, I believe. That's the way I see how it works. Well, he sells the July 15s against his long 16s, and he just waits till those July calls go to nothing. Yeah, am I crazy?
That's the other part that apparently looks like once you start digging in the open interest again, because there is that aberrant 10,000 lot of open interest on the July 16s that I was about to get into. That apparently looks like he had another position there. It's got to be the same guy playing in all these strikes. And so he apparently, you're right, he probably shorted the 15s against that open 16 position, closed out what was left of the 18s, and then added to it by rolling out on the 16s, because that July 16s are still open. He's still open there, and that's been open for a while. So yeah, this is a bit of a puzzler, but a fun and interesting one to parse. And listeners, you're welcome to play the home game with us and to dive through the open interest and look at how these kind of things play out.
And then actually you put them on a watch list. How I take these open interest trades, if I don't see anything that is super wiggly right at the beginning, you take the name and you put them on an open interest on a watch list. You got some guy out here that's been buying these things, and see if you can actually get any moves post this in volatility, and that you might end up with like either some good spreads to trade or decent trades to put on and kind of piggyback if there's any merit to this guy buying all this stuff. So generally, I don't do stuff right away. You kind of wait maybe day, 2 week, depends on if you see any follow through or not.
All right, and with that bit of a head scratcher, we're going to close out the old on block for today and dive right into the Xpress Block.
The Xpress Block, brought to you by Options Express. Options Express lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources, Options Express is the online broker for all traders. Best of all, Options Express allows you to trade stocks, options, and futures all in a single account on powerful yet easy-to-use trading platforms, including mobile devices. Visit optionsexpress.com/OXradio for your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, and welcome to the Xpress Block. This is, of course, a portion of the show where Mr. T-Nav holds court and Andrew and I sit chastened in the corners with our dunce caps on. Today, Mr. T-Nav, my birdie network told me that you may be discussing earnings and some of the things you may want to be concerned about when trading and trading options, obviously, going into earnings. So maybe why don't we start with that and you dive into some of your points, and then perhaps we'll finish up with that and dive right into the mailbag where we can get into these questions in a little bit more detail. Does that sound good?
Yeah, sounds good to me.
Okay, go for it, sir.
Well, I mean, earnings is another time that is like expiration, where I try to tell people, have a plan. If you fail to prepare, then prepare to fail. A question that I get a lot is, okay, the earnings came out, and the earnings were good, stock's going up, and my options losing value. Why is that? And I know that we've talked a lot about this before, but again, it really happens a lot around earnings where, number one, the price of the options determined by supply and demand. People buying and selling these options, they're agreeing on a price, and that's why that price is trading. Number two, when you bought the option, you probably spent a little bit of more money on, the volatility part of the option, which, added to its premium. And now that earnings are out, expectations are over, that volatility factor is losing the price of the option. So, those are two big instances that I get, around earnings season. Another one would be, for example, can I trade the options in the after hours market? Unfortunately not. I know the people right now on the desk are probably getting calls on Netflix. I've got this put spread that I had sold and stock's around 87. It's, I've got an 85.90. What do I do? And, here again, have a plan, have, what was your plan going into the trade? If it's a weekly, if it's a monthly, trade's not over yet, just because we have this one big day. So, I try to tell people, stick with your guns, and, if the price closes below a certain level, if there's something that, changes your mind on the stock, then you can, make a decision to get out of the options. But, you don't necessarily have to get out just because of what the stock is doing now. The trade's not over. And then, secondly, kind of on that point is, the option prices tomorrow morning when the market opens, they're going to be all over the place. Try to limit your market orders. Try to refresh the quote as much as you can. Options Express has a really good option order ticket, so you can see the actual quote just to the right of the order. There's a little refresh button there. You can constantly refresh the price of the option. So, trading options, after earnings with regards to the price of the option or what type of order, that's very important. And number two, kind of realize that, if you bought the option just before the earnings, you may find that you spend some more money on the premium, all because of the expectations, built into the price of the option, otherwise known as the volatility factor, the extrinsic value of the option. So a couple things, to be concerned with around trading on earnings.
You mentioned, Tim, the possibility or the desire by many retail customers to come and try to trade options and close out positions in the after hours. And that is actually a great source of frustration for a lot of retail options traders. They can trade underlying, albeit on very wide spreads, but they can't trade their options positions. And usually a lot of the bulk of the move in a lot of these earnings announcements, like we're seeing right now with Netflix, down 15 or so handles, that the bulk of the move typically occurs in the after hours, and they can't participate in that. And I know just recently, at one of the most recent industry conferences I was at down in Boca about a month ago, for the first time I heard an exchange CEO ask that same question. Why can't we allow that? So there might be a movement afoot to perhaps loosen up those restrictions a bit and put something up in the after hours for retail to trade on. Whether, I don't know whether it'd be an RFQ or what it would be. Obviously, they'd be extremely tight and you get a lot of possibility to be run over. But on the flip side, it would also provide an extra liquidity outlet when needed in times like this, when the underlying is way off and you probably just want to close out a position. And you don't want to deal with having to wait until the open and then seeing what you get, and of course becoming a victim perhaps to the IV crush that happens after earnings and all that fun stuff. So that'd be interesting to see if a groundswell builds around that, and perhaps we can actually see something develop where active retail would have a chance to close out, let's say, a 10 lot in the after hours. That would be great.
Yeah, I think after hours gets just a little bit too much attention. Sometimes I'll have people just call to want to do something in the after hours on a stock, and how come the bid ask is so wide? And I'll say, well, no one really wakes up and says, all right, it's after hours trading, let's go. No, it's really there, kind of like what you said, to provide to allow you to get in or get out, but that's it. There's no real trading that's going on there, and I think that's what people kind of have to remember. If you must get in, if you must get out, there's your place, but it's not really the place to go and trade.
Yeah, I wouldn't be looking to open options positions in that after hours unless there was some real discrepancies you want to take advantage of. But if you're looking to close things out and take a profit, cut a loss, that's the ideal place to do that sort of thing.
And, it really does get people's attention, oh my gosh, stock's at 87. And yes, okay, that's, a bit of a shocker there, but there's a whole day of trading tomorrow. We have a whole week left. I think too many people sort of draw conclusions right away, based on what it's doing right now in the after hours. I think it's a good guide, something to keep your eye on, but it's not really where all the action is.
So you would be averse, it sounds like, then, to allowing some sort of RFQ book or something like that out in the after hours to close out some of these positions.
That's tough. I'd have to hear more about it. But again, going along, gives you an opportunity to get in or get out. If that's the case, I would be a little bit in favor of that. But just kind of opening it up, for trading, it's I don't think so.
Mr. Tinav has spoken, and it is a resounding nay, sir. He is not a fan. So with that sentiment, we shall close out the old Xpress Block and dive right into a very interesting and perhaps very active listener mail block.
Now it's time to empty the mailbag and see what our listeners have to say. It's the mail block.
All right, and welcome to the listener mail block, and we're just going to dive right into the fray here with the first question, which actually dovetails very nicely with what we were just talking about in the Xpress Block. This was an email from Dan, I suppose you pronounce that, Telefi in Vancouver, BC, and he writes, I know that you guys regularly disdain buying premium ahead of earnings, but what are some of the scenarios where you would actually consider going long options into earnings? Bear in mind that I don't have the capital or really the sophistication to delta hedge my positions, so I'm not going to be able to lock in, quote, cheap vol. So I'm really looking for scenarios that would be suitable for the active retail audience. And Andrew, I could see you champing at the bit all the way across our Skype connection here, since you are the degenerate premium buyer among us. Why don't I let you run with this one first?
There is none.
Spoken like a degenerate floor trader, sir.
The problem with betting on earnings is you've got, it's a binomial thing. You have so little room to be right or wrong. Now, what I will say is every once in a while, actually, I was just talking to Mark about this, about Netflix, you have like the butterfly chance where you possibly set up a butterfly. I think butterflies really are the best low-cost way to have a decent return. and they're very not margin intensive, but they're commission intensive. But for retail, that really is kind of the only way if the pricing is not too bad. Like at Netflix, actually, the fly set up pretty good prior to earnings. And it looks like they work out okay today. Obviously, anything bullish worked awfully. So, but that's really what I would say the easiest way, because the reality is, he's trying to. What he's saying is I can't delta hedge my position. So what is that? So he's got to be long or he has to be short. I mean, the short time spread actually works well at earnings, but you need portfolio margin to put it on without it costing you a fortune. So I think the butterfly is probably one of the best earnings plays that you can do, or the iron fly, essentially, where you kind of sell the guts and you buy the wings. And
I love my iron flies.
Of that is really the only thing I have that has a reasonable shot at working, unless you're just go bull and you want to just buy call spreads. In general, call spreads will always be better because your Vega risk is almost nothing.
I just wanted to add that, we have a tool at Options Express that I've shown a lot of customers, and he can contact me if he wants, if he has an account here, or if he signs up for a virtual account, and it's an option pricer. And, because I get a lot of phone calls of people wanting to buy calls, before earnings. And, when I kind of go through, the scenario with them and what can happen or what the risk is, they'll say, well, what can I do about that? Or kind of show that to me. And, our option pricer, in addition to the pricer on the order entry screen, will show you, where is this, what the volatility of the option is trading at. And then there's a place we, can go look at and say, look, here's historical volatility, and now you're about to go pay an option or go buy an option that is 20% more than that historical volatility. How do you feel about that trade? And it really just wakes them up.
That's a great tool.
And as far as this gentleman here is concerned, I think kind of the one thing that he would have to do is just go, find a stock that he likes, and then just really look for the calls against the pricer. Anything where he can kind of see, historical versus implied, and then say, sure, this option might be a couple months out. Maybe it's in the money. Maybe it's way out, whatever. But you know what? At least I'm not overspending on this option. And I think that's kind of what he has to, the approach that he has to have. Little labor intensive, but definitely they'll feel a lot better once they know that they're really not overspending for an option.
Yeah, and I think all of us here would counsel that no matter what you do, it's exactly just like Andrew said, it would be some sort of a limited outlay type trade. We don't want you coming in there and just loading up on front month ATM straddles, going into earnings and letting the dice fly high. You want to have some sort. Let's say you are the as your question implies, the active retail customer, and you're somewhat cognizant of volatility, but you don't have the account muscle or the knowledge or whatever the case may be to really want to actively delta hedge your positions. You can still be cognizant of things like volatility, and that plays into things like front month straddles very easily going into earnings. You can go back and do your homework and look how the underlying has performed versus how the options market has priced that from a volatility perspective. And if you get a sense that you think, hey, the market is underpricing what I think the earnings movement is going to be, that's in a de facto way of trading volatility without actually having to delta hedge your position. Then you come in and use one of these positions that is a limited outlay type position. Perhaps you do the long iron fly where you're buying the guts, selling the wings, so you're limiting some of your exposure and you're hoping to capture that extended move that you expect in the underlying. And there are ways to do it. It's not like we say on the show, never ever, never ever by going into earnings. It's just that it is a relatively low probability trade when you do get into that. And if you are going to get into that type of trade, be aware that the odds are typically against you. 9 times out of 10 in most earnings scenarios, premium evaporates after the announcement actually comes to fruition, whichever way, shape, or form that actually happens. And so you have to deal with that balloon deflating, and your underlying supposition has to be correct to the tune of offsetting that volatility implosion. So that's a difficult thing for most people to be able to do, which is why we typically don't counsel that traders do that. But there are nuanced ways you can approach it and minimize your premium outlay, minimize your exposure, and give yourself a better chance than
right to succeed.
Exactly.
And OX should put a blinky light on the option pricer. What people don't really understand is there are two extremely variable inputs to option pricing. The one that 90% of the ink, 99% of the ink is spilled on, the magical where the price of the underlying is going to be, okay? And there's 500 ways of Tom, Dick, and Harry on how to figure that out. And the other 1% of the ink that's spilled, this show is one of the 1%, is the change in volatility affects out-of-the-money options almost more than the underlying price does. So the thing is, if you don't learn how volatility is going to work, you're only giving yourself a 50% shot at succeeding anyway. So you might as well just go and take your head and whack it on the wall a couple times and then go trade, because it's not going to help you. So OX, was set up by option traders, and they've got all kinds of tools like this, and you got to learn how to use them. So I'm all for the public being educated, because they end up, making smarter trades. That way they can get the delta that they want on the particular trade. They think it's going up, and they can pick the right option scenario. If you give me what you want to do, I can find you the perfect option scenario. And that exists every day. So people have to learn that there is a way to maximize what you want to do with options. There is a way. There is always an ideal way to get the trade on. But that, by the way, is like an unforced error. Anybody can learn how to do that. That's what we teach at OptionFit. That is totally teachable. Most of the people get in trouble because they put something on that actually is going counter to really what they want to do. And you have that tool at OX, you need to use it and learn how to use it. Now I'll get off my soapbox.
Well, we are running a bit long here, but I want to make sure we get one more question in on the old mailbox, because we don't get a chance to peer into it as often as we'd like. So let's just hop on a quick one here at the end. We'll save the other one for another listener mail segment down the road here, but we'll dive into a question from our old friend Delta Trader here on the forums, and he asks, what is the point of open interest? Mark and Andrew, he writes, were pretty dismissive of using open interest to inform your options trading on a recent episode of the Option Block. My question is this: if you're not supposed to use open interest to inform your options trading, then what is it good for? And Delta here is referring to a discussion Andrew and I had on a recent episode where we discussed people perhaps conflating what the actual purpose of open interest should be, and looking and only diving into names and perhaps even strikes that have a high degree of open interest. And that's, as we said on the last show, is kind of putting the cart before the horse. You really want to look. Open interest is important in the sense that it gives you a feeling for how active the underlying is. But what really matters and what really should reflect that open interest and the volume level and liquidity level in that name is the spread. And that will tell you right away, and the size on that spread, exactly all you pretty much need to know when you're trading an underlying is how tight is the market and how much size is displayed on that bid-offer spread. You can have all the open interest in the world on a particular strike. If the strike is still $1 wide, one contract up, that's not going to be of much utility to you. So, and on the flip side, you can have no open interest, but the strike could be extremely tight with a lot of size on the bid and offer. So that really is where you should begin, and in most cases end your investigation, is really how tight is the spread, how liquid is that spread and that strike that you want to actually trade. And then if you want to do a little homework and see maybe what people have done before and what other positions are outstanding, that's worthwhile doing with open interest, and that has some value. We see how we used it in the recent odd block to try to attempt to parse what had gone on before us in this underlying and in this option, try to get a feel of what that trader had on. So that is interesting, because then you can use that to anticipate maybe what they're going to do to unwind that position. But other than that, really the spread should tell you 90% of what you need to know in a particular option, a particular strike. Would you agree with that, Andrew? Am I putting words in your mouth?
No, I agree. I agree 100%. And also, too, just take a look what's going on with the, I always say the underlying volatility tells you a lot. So is that open interest, did that open interest move the needle? Did they take liquidity from the market? Did they provide liquidity to the market? It's always good to have price and volume information. So I always, how does it change? How does the volume change the price of the option? And a lot of times that gives you a fairly good answer if what the market is thinking, because the best thing about an option class is, everybody in the world is looking at those Apple options. So you've got, a million participants trying to dissect what's going to happen. And that usually is a pretty good tell on what's going on, because you're going to see how their sentiment trends by seeing, how volatility and things like that work. So, I agree with you, Mark. It is a good open interest has a use. I don't think it is the giant indicator that some people make it out to be.
Well said, sir. All right, and that is going to do it for the old listener mail block. If we didn't get to your question, don't be discouraged. We'll get to you on a future show. We're trying to, whenever possible, squeeze in a few questions from you guys. So it's not just us gassing on all the time on the show. You guys have a chance to sound off as well. And now we're going to dive right into Around the Block.
Around the Block.
All right, and welcome to this abbreviated Around the Block segment. We are running a wee bit long here, so we're going to crank through a couple of the upcoming announcements and upcoming developments we're watching on our calendars. Of course, the big 800-pound gorilla is, of course, Apple, which is coming out tomorrow after the close, so we'll all be paying attention to that. It's unfortunate good old Uncle Mike Tusaw was not here today, because that is his bread and butter. That is what he does pretty much all day long, is roll Apple calls. and probably in this case, puts for the first time in quite a long time. So that'll be interesting to watch how that unfolds and where that takes the market, of course, if Apple deeply surprises to the south. That might be an interesting bellwether for what we can expect to come. Of course, already Apple and the downturn in Apple is taking NASDAQ vol to one-year records, so we'll see if this continued decline in Apple will have a continued effect across the broad market. I am guessing that it will. Staying on the old technology tip, we have Andrew's favorite, Zynga, coming out on the 26th. So, Andrew, are you going to do some stuff going into Zynga earnings?
I'm trying to. I'm looking at the Zynga. It looks pretty vanilla pre-earnings to me. As much as I want to do stuff, I haven't. There's nothing I've seen actually that looks that interesting. If anything, I would probably be just a seller of the juice in there for the earnings. Although the stock going back down to $9. Yeah, Facebook all of a sudden, they're spending too much money on stuff, and they just paid $1 billion for a company that does nothing. So Zynga might start to be painted with the brush now. So everything was hot in social networking, and this week it's not. So I would like to do stuff in Zynga. I don't see anything really fantastic as of this moment. But, the volatility is getting bid up pretty good. I don't think this is a really big earnings stock, actually, as far as movement so far. I mean, it has such a brief history. It's hard to tell, but.
Yeah, it hasn't gapped too dramatically off of earnings of late.
You probably sell some May 7 puts for 20 cents, and, I guess you could get in trouble, but I think it would be kind of hard. I don't know how much upside I would sell on the thing, but. Again, I don't think there's anything real demonstrative in there around 100 vol. Everything's kind of fairly priced, just fair. Nothing super sexy. Although they are bidding the upside up much more than the downside. That's the only thing I really notice in there. So, if anything, there's a little bit of hotness on the upside for the Zynga.
For that Zynga juice. And, of course, you also have Amazon on the 26th and good old Ford, one of my old favorites, on the 27th. Anything else you two are watching around the block, Tim or Andrew?
I'm just watching news. I think we'll have a pretty good news week. And in addition, I think there's some crude oil inventories. That'll be interesting to see where we go there.
I assume we got a lot of it.
Yep, we sure do.
I know. I myself have a little interest in that. Another thing I'm looking at, as CHK bounces around, Nat Gas made a big, huge move today. The much maligned contract, the UNG was up, 69 cents on the $15 number. That's about as big as that thing moved. So that was almost wasn't quite 5%, but 4.5%, which is a pretty big move for natural gas. So that must have been the dead cat bounce of the century, it feels like. And the TLT. Why does the TLT continue to climb? I think that is the name that defies any inflation expectation whatsoever. Go out and borrow money from a government that can't even pass a budget. And I think that's what you got there with the old TLT. So I'm still, I started putting little tiny positions on in there, and we'll see if we can add something else. But I'm looking at just kind of the big macro stuff, to be honest. And besides, we've had, I think the last thing is just the tech has been sold off pretty heavily the last 2 weeks. So I think any little surprise from Apple, even if marginally good news, will be a little buoyant for the tech sector as well.
You have to wonder.
I think everybody's just kind of waiting for that.
How can Apple surprise at this point when the expectations, even after the sell-off, are still so lofty? It's kind of difficult to surprise to the upside. They've managed to do it a few times, but still, it's just that's difficult to maintain that rhythm. But speaking of rhythm, unfortunately, that's going to be the end of our rhythm for today, the end of our show. But before we go, we will dive into what we're looking at and what's coming up at our various outlets. A quick roundup here, or recap, I should say, of Netflix as well as we close out the old show. As we're finishing up here, it's trading about 85 even in the after hours, so looking like it's continuing that downward spiral there in the old widowmaker. Speaking of making widows, Andrew, what is coming up in the land of the pit that may interest or intrigue our listeners?
Okay, we have our weekly webinars. The webinars on the weeklies. We just have one. You can download it for free. It has been downloaded a bunch of times. Apparently, somebody trades the weeklies. They are going to become progressively from beginning, intermediate to advanced. So May and June, right around the middle of the month. We are also having our gigantic option pit extravaganza in June, where we will be dining and feting and teaching our option clients how to trade options. Kind of more real. We do a lot of stuff via webinar and one-on-one interaction, but this will be sort of live, where you get to kind of touch people and go back into the old days where we had that kind of human interaction. So that's the big stuff. We also have a big top secret thing happening. Cannot disclose it yet, but we are getting closer, shall we say, to the big one. And that's where we are.
All right,
things are going okay at the pit.
Thank you for that tease there, Andrew. We'll have to wait and see what the big top secret thing is. I hope it's not another shirtless calendar from you guys, because really the last one was more than enough, I think, for me and for many others out there in the audience.
The shirtless calendar sold well. We sold twice as many as we thought we would have. I think we hit 2. One to my wife and one to Mark's wife. So we were pretty jazzed about that.
There we go. Speaking of uncomfortable things on the horizon, what is coming up in the land of OX, Mr. T-Nav, that may intrigue our listeners?
We have a workshop. It's on Thursday, May 3rd and Friday, May 4th. It's sponsored by Schwab, the Options Institute Plus 2-day live Chicago workshop. Starts at 9 a.m., goes till 5. It's at the Options Institute, 400 South LaSalle. The event, normally valued at $1,750, is being offered at a discounted rate of $800. So that might be of interest to some.
Can they sign up for that on the OX website, or do they need to go to the Options Institute website to do that?
They actually can do it at SIBO. There is a link at the SIBO, and they can contact Options Express.
All right, so listeners, if they're interested in that, by all means, surf on over to the CBOE website and click on the Options Institute tab there, and you can find out more about that event, and you can register for it. And certainly, if you do attend, tell them you learned about it from Mr. T-Knob over here on the Option Block, and he'll get a nice bonus And then, of course, they couldn't make it today, but we should still, of course, mention the boys over at KYO. Check out knowyouroptionsinc.com. Click on their free 18-minute portfolio review and learn the magic that FHM and Uncle Mike can work for your portfolio. And, of course, last but certainly not least, if you want to listen to this program or any others or check up on any of the content we discuss on this show today, as well as a lot of other interesting content from the world of options, then surf on over to theoptionsinsider.com, and I think you'll like what you'll find over there. And speaking of liking what you'll find, that brings us to the conclusion of this show, but we'll be back again very soon with another episode of the Old Option Block. So we'll see you next time.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.